Thank you, everybody, for joining us today. We are going to do a deep dive on manufactured housing compared to apartment buildings and thinking about this from a capital allocator's viewpoint, a limited partner's perspective, comparing both the risk and some of the reward. So let's dive in here. We have Ian Fisher and Brad Johnson here with Vintage Capital, and thanks for joining us this morning and this afternoon if you're on the East Coast. All right, so do these guys know what they're talking about? Here is our track record. I've been started investing as an operator in 2014. We have invested in quite a number of pads so far, a large number of deals, a fair amount of funds at this point, and have a stellar track record in the space, which includes a lot of deals that we've decided to hold long term to keep benefiting from the cash flow and the tax benefits, and have refinanced a fair amount of capital out on those deals. One we've done twice, which is always fun. And then certainly some full cycle deals as well.
Great. And then just quick backgrounds on us. So starting left to right. So Brad is from an institutional real estate background previously, and closed over $3 billion in commercial real estate acquisitions with Eastil Secured and a couple other groups. Then built an operating platform in the MH space of about 2,000 pads spread across the country. Lots of lessons learned from that. Subsequently sold that portfolio down. And he and I have been allocating together in the MH space for about the past 6 years together. I come from a management consulting background in a prior life and have been in single family rentals as well, where we've got an operating platform separate to this. And as I said, I've been partnering with Brad for 6 years or so now across a lot of the track record that you saw on the previous slide. And then not with us today on the call, Tom Perchetti is our head of investor relations. He's been working with us for a couple of years now, and is likely someone that you've spoken with or will speak with if you've got further interest in a one-on-one conversation. So that's the three of us, and then we're supported by a team of accounting and operations, and obviously through our operating partners, significant larger support network as well.
So just to start, the data in the manufactured housing space is difficult to track down. So what we've tried to do here is aggregate a lot of different sources to give you what we think is a pretty comprehensive view of the industry from the available data. Now, there certainly is some truth to the fact that this is an inefficient space. There isn't as much data as there is for the multifamily world and the apartment world, but it gets better each and every year as more institutional buyers start looking at the space and start dipping their toe in, which has certainly happened the last 5 years. So here's just an aggregate, and there will be a recording of this, so don't feel like you have to scribble notes furiously if you're that interested. But I just wanted to give you an overview of how we thought about the data for this presentation.
Also, sorry, I'll just jump in real quick. Please put your questions in the chat box if you have them as we go. I'll try to get to those towards the end. Sorry, man.
Yeah. So I think it's helpful for context of what type of properties are we talking about, because it is a spectrum, just like apartment buildings, of quality. And so we are not talking about a trailer park, something that is an eyesore, that is unsafe to live, that what you might see on The Simpsons if they were showing a trailer park. We're talking about nicer communities, affordable properties, and a little bit of the 55 plus, the senior communities would be in that level 5 range typically. And so this is helpful context, I think, in bracketing the type of data that we're sharing today is certainly on the higher quality end. Doesn't mean they're all 55 plus Miami Beach senior parks. It's a spectrum of 3 to 5 star properties, probably an average, 3.5, 4. If we just zoomed out in terms of the data that we're sharing today. Right, so it's going to look something closer to this. This is at the higher end. This is likely a 4 or 5 star. This is more of a 3-star, right? Where it doesn't look like a subdivision, but still nice, clean, safe community, parking, ample parking for your individual lots. And then here's the business model, right? So many of you probably understand this already, but just before we dive into the data, I think it's helpful to understand, like, what are we actually talking about here? This is a different, structurally different business approach to real estate than just about anything else within the asset class, right? We are infrastructure owners, really. We are providing the land, the pads, the roads, the underground utilities, the connection to those utilities for each individual homeowner. The tenant typically owns the home. We own the infrastructure. And so that has a lot of benefits that flow through to all the data that we're sharing today, right? So there's no individual expense requirements or maintenance issues for the individual homes that we do not own, right? Something breaks in the home that needs a new appliance, that is on the tenants. That's the tenant's responsibility, not the individual park real estate owners. And that translates to lower ongoing expense ratios relative to apartments. I often hear 50% for apartments. I know it's a spectrum too, but and that's obviously true for mobile home parks as well. But they're almost certainly across the board. If you look at each sector, there's going to be less ongoing expenses on average for mobile home parks, given this business model versus apartments. All right, so NOI growth and volatility. So we're looking here at the red line is manufactured housing NOI growth over the last 17 years. This is largely the REIT data. We don't have an industry comprehensive view of every single mobile home park because it's fairly under the radar. But looking at the REIT data as a proxy for the overall industry and the higher quality mobile home parks, you can see the NOI is incredibly stable relative to apartment buildings, which understandably can spike up and down with economic booms and recessions. And so if we just think about this in terms of how these things have performed in recent recessions, right? You have GFC, obviously apartments had a rough go. Just about every asset had a rough go, but the NOI for mobile home parks, given that it is the most affordable housing option, was quite stable. And the main takeaway is thinking about this industry over 24 years. There's actually never been a negative year of NOI growth on same store, right? So that is the existing assets, looking at those year over year. There has never been a decline in NOI for the 2 largest REITs in this sector, which is pretty incredible if we think about the risk of asset classes versus other sectors within real estate. Here's another version of that, right? And thinking about it in terms of the sensitivity to GDP. Obviously, hotels, very sensitive, highly correlated to fluctuations in the economy, whereas mobile home parks here down at the bottom is a fraction of these other asset classes at the top. So why are expenses a little less volatile in this space? It kind of reminds me of a net lease business model in some regards. Now, not all of the expenses are passed through to the tenants. Certainly, there are common area expenses that the property needs to take care of, but it runs, right? So there's no turnover cost when somebody leaves a home. If they leave and they sell it to somebody else, you have a new tenant that might be sending in the check, right? There's a different name on the check, but you're not having to repaint, recarpet, redo the kitchen as you often have to do in the apartment world, where a turnover cost could be, thousands of dollars. The high end of that if it's a much older property that you're trying to upgrade over time. Payroll is a little bit less per full-time employee. It's easier to manage these things when the tenant owns the home. You are often mostly just the property managers are kind of babysitting. They're watching to make sure the rules are being followed, the rent checks are coming in. There's not as many ongoing maintenance calls, of course, if you're not responsible for the interiors of these homes. Insurance can be quite expensive in Florida, of course, given the weather risk. But within just the broader industry, the insurance has been a little bit less because mostly what we're insuring for is liability. When you own the infrastructure, there's no structure that you own. Obviously, your premiums are going to be lower versus a large apartment building with roofs and appliances and boiler rooms and furnaces, right? So there's just going to be a lot less from just a value standpoint that's ascribed to the physical structures for a mobile home park versus an apartment building. Property tax reassessments this is a state by state, county by county issue, but oftentimes you'll see the increases in property taxes for mobile home parks are not as rapid. They don't adjust as fast as they can in some other real estate asset classes because they're largely focused on the land value. A lot of county real estate tax assessors are not valuing the parks on a cap rate, on an income-based approach. They're often they're looking at other land values in that area and growing property taxes accordingly. So this isn't an absolute. Sometimes you will get assessors that will aggressively look in and try to figure out what the purchase price might have been in a non-disclosure state and try to up property tax expenses. But overall, the industry tends to be a little bit lower on tax increases. And then we talked about the utilities. There's a lot of parks where you're not responsible for any utilities. They're direct billed to the tenants, which means there's no leakage from the standpoint of a master meter utility, which then you are reading and then billing each sub meter, right, for the tenant's individual usage. So those properties have very low operating expenses, can be as low as 20-25% if all the bills are directly sent to the tenants from the utility provider. And it's very rare. I have only done invested in one or two parks over the years that actually is responsible for electric billing. Normally, electric and or gas is a direct payment to the individual tenants. So the structural moat within manufactured housing really is a function of supply. So we do not see new development in the space in a meaningful way, right? There's 20 parks about a year. If you look historically, 20 is a pretty good number for the number of parks that are built each year that are increasing the total supply on a base number of, call it 45,000. The range typically, depending on who you ask, is anywhere from 45 to 50. There is probably 10,000 parks, maybe 15, that we would actively look at investing in. But if you just think about it as the overall industry, it's still basically a rounding error, zero, relative to the existing supply. Whereas apartment buildings, of course, in the peak of 24 was a record year. Nearly 600,000 units were added to the overall supply. And of course, we saw some softer rent increase numbers because of that supply. When you have to think about a new competitor possibly coming in any given time, when you own an apartment, it makes things a little bit more challenging to underwrite the future pro forma of that asset. Whereas with manufactured housing, we actually don't need to worry. If you just look at a portfolio, right? You could get unlucky, of course, on one of these 20 parks. But if you're looking at the industry at large, you're not going to see any new meaningful supply because of the three things that we've highlighted here at the bottom. Sometimes in counties, the zoning is actually illegal. They've adjusted the number of units per acre where you can't even get these things started. And then if you do get something started, you get a kickoff for development and you're applying for entitlements. The pitchforks can't come out There is a stigma to this industry, as you can imagine. There's a giant gap of misunderstanding between the nicer parks, especially newer developments are beautiful. They look like subdivisions with brand new homes that look very similar on the interior to a stick-built home. And so there's this big misunderstanding, and that leads to big-time challenges when it comes to development. And it takes a while to infill the parks once they are, if you do get one of these parks that these 20 or so properties approved. And then, of course, there is some political risk in this space relative to apartments. It's not all rosy. We're not doing this presentation to say that apartments are awful and mobile home parks are the best thing since sliced bread. We just so we want to highlight the fact that yes, there is more regulatory attention on this space in blue states than there is on perhaps apartments as of today. So you have to factor that into your analysis and your portfolio construction. We do that by largely avoiding most blue states and keeping our eye on purple states, as it were. So thinking about this as a risk versus return asset class, how has this performed in downturns? Well, we've talked about it from an NOI standpoint. Here's that same comparison highlighted in the last 3 downturns versus apartment rent growth. And if you just think about this as how would I compare this versus some other asset classes? Well, it's incredibly rare to be able to count on steady and growing rent assumptions, revenue growth assumptions into the future, and especially past 5 years. I often feel like a model in most asset classes is fairly worthless after 5 years. But if you look at the last 24 years in this space, it has been up and to the right for steady rent growth. You're not going to see the 15% years like we saw in apartment buildings shortly after COVID, right? So we're not going to have as big of a boom, right? You're not going to want to try to pass through on a stabilized deal that's already at market. You're never going to pass through a 20% rent increase on a full park that you've owned for 10 years, right? You're going to continue to do that nice steady 5, sometimes 7 if CPI is really spiked type of rent increase. I've actually never looked at a deal that has a negative year of rent growth. It has always been slow and steady up and to the right. And that does some unique things from a return profile when as Warren Buffett has said, don't lose money, right? So we don't have these giant spikes, but we don't have these down years. And so that just compounds over time, right? As we get the benefits of operating leverage because our rent is growing faster than our underlying expenses. All right, some of the other headwinds to MHC, we talked about the public perception risk. This low to moderate, I would say that is in red states. In blue states, it's certainly high, higher than low, right? Blue states, you have to be careful about rent control, right? The worst time to invest in this space is right before the rent control would be passed. If you were looking at blue states, we are often open to investing in parks after that rent control has been passed, like in the Pacific Northwest, for example, because we can underwrite it now. The challenging part is a state maybe like Michigan, where they're hinting at it, they're talking about it, they're flirting with it, but we don't know if it's actually going to be implemented. So starting at the top here, we talked about it mixed, and that's a state-by-state risk. Smaller liquidity pool. This is definitely a factor, right? We do not have a giant amount of transactions relative to apartments, right? Apartments are huge, that industry compared to our space. Now, granted, it's gotten a lot better. There is Fannie and Freddie are in our space now, are the major lenders to the asset class, but we don't have thousands and thousands of buyers looking at buying and manufactured housing. The large players, the private equity firms, have started to get into the space. They really like, 200, 300 pad plus parks. So there's certainly a lot more liquidity in the space than when I started, but it's not as attractive as apartments, just as a comparison. Infrastructure tail risk. So a lot of the parks need some capital, right? The people that thought this space was going to be just a cash cow, I'm going to get in, I'm just going to increase lot rents and collect these big coupons, are misguided. This space needs capital. It needs improvements to be made to ailing infrastructure. If the park has been owned by pop, right, mom and pop for 30 years, and they haven't reinvested into the parks over that time, they've just been using it as their main source of income and have let things dilapidate from a road standpoint, from a pipe standpoint. And so really, one of our favorite things to do in this space is come in with a large capex budget year one, really improve the roads, start fixing up some of the common area, improve some of the homes, help out some of the tenants that have the older homes, give them paint, give them material supplies to help fix up their home and their lots, and then use some money to expand the park or infill any vacant pads, which mom and pop operators typically do not do that. Typically, they let a small percentage of the lots over time go vacant. Just maybe the home became too old, or every once in a while, sometimes it takes 5 years, but every once in a while, a home will leave a park, but it's pretty rare. But mom and pop operators typically don't have the capital to come in and make these type of improvements, especially when the newer homes can be upwards of $100,000 in coastal markets if you're doing a nice double wide, or $50,000, $60,000 maybe in the Southeast. Here's the occupancy chart over time. Once again, there's stability of manufactured housing. It has been on a climb, at least from a REIT standpoint, because we're not building any more of these things. And so in nicer markets and in nicer parks, the supply is getting tighter and tighter. Here's some color on the exit liquidity on the transaction volume that we talked about, right? We're talking about tiny fraction relative to apartments, which does lead to some inefficiencies, leads to a little bit of alpha ability relative to, I would argue, a very competitive apartment market. Of course, you can drive alpha in the apartment space if you can buy off market deals, or you just have an amazing operations team that can drive NOI growth. Whereas the MHC market, it's slightly easier on both of those fronts, I would argue. The main alpha drivers in our space are the hairier deals where you're coming in and you're injecting capital, you're increasing the number of homes, you're infilling a park, but you're having to go maybe 30, 45 minutes outside of a larger MSA. In the middle of MSAs, in large markets, very little vacancy. And so the core plus, I call space in manufactured housing, is something like in a Phoenix, where the park is full, the owners owned it a long time, hasn't fully kept rents up with market, has kind of been casual about maintenance. And so the opportunity in those type of parks, that looks more like a bond, whereas you're coming in and you're tweaking the expenses, you're tweaking rent growth, and that looks more like a low teens type of return with, I would argue, lower risk historically. Okay, so all that's great, right? But how do we know? How do we know that the market agrees with that data? How do we know that that is likely to continue? Well, if you think about the public market as a very good forward-looking data set, you can compare the largest two REITs in the space in manufactured housing to two of the largest multifamily apartment REITs. And so if you think about their dividends, they're similar, right? You get slightly more money today with the apartments. The dividend growth, though, has been way more steady with the manufactured housing REITs, right, which makes sense under the context that we've shown in the data in the previous slides, right? Once you can really budget for rent growth and you don't have as large of spikes in vacancy or as large as spikes in your expenses, then you can continue to grow your dividend. And then all of that translates really in the market's perception of these assets, and the market loves predictability. The market really likes to increase multiples and pay up for predictability, which is why we saw enterprise software multiples get crazy. And now we're seeing, of course, those multiples come down because now there is less predictability in those revenue streams. And so the higher the predictability, the higher the multiple. And so we can see here ELS, Equity Lifestyle, that's Sam Zell's company that he founded, RIP Bud, legend in the industry. He really is the godfather of this space and helped drive these multiples up by going out and talking to bankers and explaining the benefits of this business model. And so the multiples are higher because of this predictability now. 23 to 26 multiple on AFO. You know what? I have that swapped. It's 26 for ELS and 23 for Sun. But the larger point is it's higher than the multiples of EQR and AVB, right? Avalon and Equity Residential, which is also owned by the same people that own ELS. So you can see that translates to a higher multiple. The NOI, the GFC resilience here, this is a moment in time. The total year NOI did not drop that much. It was more of the public market's reaction when GFC first started. People started underwriting much larger dips in apartments than they did in manufactured housing. Okay, and just in summary, to recap all of that data, lower turnover, the homes really don't move. I think of the tenant turnover really as a function of the homes, because the homes is more like 0 to 2% leaving individual park or property, whereas the tenant turnover could be closer to 5 to 10%. The tenant that does leave in a nice, well-located park rarely even tells you. They just will sell the home to a family member, somebody in the community. They'll put it on Craigslist and they'll sell it to somebody. So the name on the check on lot rent changes, but really the home has stayed the same, and you don't see that gap in turnover from a revenue standpoint. Lower capex per door versus apartment buildings. Land doesn't need much on ongoing expenses from a capex standpoint. And this really speaks to the strength of the business model from a capital efficiency standpoint. That first year where we come in and we do a large capex improvement plan to increase the attractiveness of the property, that's really just the first year. After that is done, the pipes are pretty sturdy, right? The PVC pipes, asphalt or concrete roads, they are not going to need a lot of capital the next 5+ years. The pipes, you probably won't touch those for 30 years. And so relative apartments, you're having capex from the roof, capex from AC, and obviously the turnover cost that we've talked about when apartment units turn. Manufactured housing is the most affordable housing option. We have a housing crisis from an affordability standpoint in this country. It's hard to see that going away anytime soon. So that leads to almost insatiable demand for affordable housing in the larger markets. It's really more a function of are there incomes to support the type of rent growth, which is modest but reliable, that we've talked about in this presentation, right? You can go almost anywhere and there will be tons of demand for affordable housing. It's more of an exercise on evaluating the incomes in that marketplace and whether or not an investment is going to be viable. And this is also useful in thinking about, okay, how do people retire on half the country having 100,000 or less in their 401ks. Manufactured housing is a version of a retirement, right? You can sell a stick-built home, take that cash, go buy a double wide in a nice location, which many of our tenants do, and then own that home outright for cash. And then you have a much lower, you've decreased your housing costs substantially, and you have this chunk of capital that you can use to fund your retirement, in addition to Social Security, of course, for a much larger and predictable period of time. In many of the markets that we looked at, that is a retirement strategy. High revenue retention. This is a function of everything we've talked about, in addition to the fact that these homes are incredibly difficult to move. It is not only painful from just getting the home ready. If you own this home and you want to move it to another park, there better be a very good reason to motivate you to do that, because it's going to be extremely expensive and it's going to be a giant hassle. You're going to have to move everything out of the house that's basically that you want to not damage. And you got to pay somebody to come and split apart your double wide and then move it across town, which is not cheap, and have it reassembled. So obviously that is a big move and rarely happens. Oftentimes that's why we see people sell their homes to somebody in the community versus outright moving it, pulling it out of a property. Supply growth. Once again, a reminder that we have not seen any meaningful new supply in this space in 15 years. It is hard to imagine that changing anytime soon. If we do, it certainly is not going to be 3-4% in the near future. And recession resistance, I think we've covered that. Okay, and so just thinking about an allocation to manufactured housing, if you do own apartments as an LP investor, as a GP, and thinking about diversifying your residential exposure, I think it is useful to add this, because it will reduce historically, if you look at the historical data, it will reduce the volatility of your portfolio, your real estate investment portfolio. And so we find it a very compelling asset class. In order to, ideally, you should, if you look at just historically, you should increase the overall return of the portfolio, increase cash flow a little bit, and then of course, make your portfolio more resilient to big pullbacks in the market. And this is another summary slide on that same point. And that is really all we have on a slide basis. I think we can pivot to any questions that might have popped up.
Great, thanks, Brad. Perfect. And yes, I've seen some questions come in over the course of the time so far, and please feel free to type any additional ones into the chat box, and we'll try to get through as many as we can. So the first one we have is, how would you describe the typical resident in your MHC for a level 4 to 5? Generational residents of MHC, what is the average delinquency rate?
The average tenant profile is tough, right? Because we own a lot of parks in the Southeast that are more for just affordable younger families. And we have invested in some 55 plus parks that are obviously mostly seniors that are enjoying their retirement. So it is a spectrum. In regards to delinquency, it's very, very little at the upper end, because you can imagine the nicer parks have nicer homes, which are quite valuable, and nobody wants to lose, the rights to their home. So they stay current on lot rent, because it's a tiny fraction, of their value of their home. So maybe it's 1 to 3% at the upper end, and it's 3 to 4% currently across our portfolio on closer to the 3-star parks. And it's at one of those levels where that type of delinquency is actually accretive to the model because of the late payment fees, which range from $30 to $75 a month, depending on the lot rent in that particular park.
Okay, great. So next one that we've got, what do improvements look like? As mentioned, when you're coming in and taking over, you start to pave roads, et cetera. But for individual homes, what else does that financial assistance look like? What are the limitations? Is there a cap on the amount you'll invest into one home?
Yeah, sorry. To be specific on the homes, it's more of an informal program. You want to encourage the tenants in the property to improve the appearance of their home. That increases your ability to get a better refinance loan with Fannie Mae in the future if that's your business model. And of course, it just helps with overall curb appearance. So you rarely are saying, "Hey, here's $5,000. Let's redo your the exterior of your home." It is, "Hey, let's have a cleanup day. Let's have a paint day." You hire painting crews, right? That will come in, and anybody who wants to use free paint and some a little bit of help from staff can take advantage of that. Sometimes it's worth it to spend a little bit of money on the roofs themselves to repaint those because you can get some rusting on some 1990 models, right? So there are things you can do at the edges. Paint is always the best ROI on any property within real estate in my view, and especially in manufactured housing.
Okay, great. So one other one that's related, if home repair is the tenant's responsibility, what rights or remedies does the landlord have to ensure a home is repaired? There's a conflict of interest there. The tenant may not want to pay to ensure quality, whereas the landlord wants the home to maintain a certain standard. Otherwise, the quality of the homes and therefore the park may go down and negatively affect rent growth.
Yeah, think about this in terms of like an HOA. So there are lot rent rules. There are rules and regulations for each of these parks that rhyme with HOA requirements, where you have to maintain your yards. You can't have like broken down vehicles right in your yard. You can't have a portable swimming pool outside. You can't let your lot go in disrepair. And so you can enforce these things like HOAs enforce them with fees, and you can escalate that right into the point of kicking somebody out of the park if they are not abiding by these rules. And so it rarely ever gets to that. I think we've, in my entire time in this space, I can think of maybe a couple that got to issuing an eviction notice based on rule violations. Oftentimes, it's just making sure that you have a property management team that has the systems and they are actively enforcing these rules and are not asleep at the wheel. That's more of the problem, is not having the right team on site that is enforcing the rules. The tenants, they want to live in a nice community. What tends to be a problem is if they see other people not taking care of their lots and they are taking care of their lot, and they're like, wait a minute, why does Bob across the street get away with his yard being a jungle, and I'm out here every week slaving away in the sun mowing the lawn? But if you enforce the rules and everybody's doing their part, it's pretty remarkable how that flows through the community, and how quickly in a matter of a few years it can go the wrong direction if you are not actively enforcing and encouraging people to abide by those rules.
Okay, great. A couple of related questions to each other, so I'll put them together. One, do we own any MHP in California? And then two, how are we underwriting the political and regulatory risk over a 10 to 20-year hold, especially in states that are flirting with rent control like Michigan? How does that change your required return or leverage assumptions versus red state parks?
Yes, we do not own any parks or investments in California. I had, for years I tried in the beginning of my career, and I couldn't find anybody willing to sell one because they knew what they owned. And we don't do it now because of really the regulatory concern. And it's not even the rent control. The rent control in California, it's like you can underwrite that. You're not going to ever increase somebody's lot rent 15, 25%, right? So you just have to get compensated for that on the purchase price. So you can underwrite that. And weirdly, you actually feel better about your model after the rent growth has passed in a particular market, because now you are 100% sure there will not be new development in that market because it won't pencil. It won't work with rent control. So the states that are purple, so to speak, that are flirting with it, like in Michigan, I think you just have to get compensated for it. You just have to underwrite and assume it's probably not going to happen, next year, but the following year, I would start dinging the model for rent growth, and therefore, that, hey, well, we better get a price that enables us to still get that mid-teen return if that's our bogey, which oftentimes is our target, and we flex that up and down based on the market and risk of the business model. So yeah, I would just say that it's something to keep an eye on. Look, there before the regulatory environment in California got so crazy, where they're awarding tenant groups and people suing, throwing in frivolous lawsuits, and they're rewarding them $100 million judgments. California was certainly a place that I would look at and would want to own. But you just treat it more like, okay, this is going to be a lower risk type of investment from you're not going to have any fluctuations of demand, right? But now, the wheels are off. I think for most real estate asset classes, investing in California, that's just my personal opinion. I have it in the too hard bucket. New York is a little bit like that for us. We don't own any parks in New York for the same reasons. I just think it's too hard to price outlier risk from the regulatory standpoint. And so we'd just rather skew our portfolios to the states that are very business friendly. I just think it's life's too short.
Great. Okay, so there are another couple that go together. So when we were talking about the different levels of MHC, levels 2 and 3, et cetera, is it entirely based on the quality of things inside the community, or do you also factor in proximity to important outside needs like grocery stores or a gas station? And then what amenities bring value to a level 4 or 5 MHC?
The amenities don't drive a lot of value. It's more of just doing something nice for the tenants. Because it's not really like apartment buildings. Oftentimes, like the gym in the community center is really just to attract tenants, and they don't get as much use as you would assume. Whereas with manufactured housing, there's very few tenants go like, oh, we want to live in the park that has all these amazing amenities. It's mostly they want an affordable place that that is safe and clean. But you can add a dog run. The affordable parks, you can add soccer fields, right? You probably, adding pools is probably a bad idea in most markets. You tend to get more problems than the amenity is worth. But you can do things on the margin from an amenity standpoint. The really nice parks, like in Texas, that are being expanded, will look like new stick-built home communities. Will have giant walking areas, and they'll have basketball courts and pickleball, right? Because there's just more space to do things like that. But in most markets, you're not going to have the amount of space to do a huge amount of amenities. And then, sorry, Ian, what was the first part of that question?
So whether our notion of star ratings is based primarily on characteristics inside the park, or how location and proximity to other amenities in the community, plays into how we think about that.
No, the star rating system is really defined just within the property bounds. And so it's the width of the roads is a big one. Does it have rolled curbs? Like this little picture here in the right-hand corner has got a curb to it, but it doesn't have giant wide streets. So this one's kind of like a 3 plus. And so it's more about the condition of the roads, the condition and age of the homes, the type of roads, the type of utilities, right? If it's public utilities or not. So yeah, it's more about the infrastructure than it is the area. So the area, obviously you want to be within driving distance of these things. The fundamental laws of real estate have not changed, but you can go further out in an MSA than you might otherwise be comfortable with investing in apartments, right? Because people who elect to move to a mobile home park, they want space, right? And they're more comfortable with a more rural country environment than somebody that wants to be in the action that might be 28. and has a pretty high paying job, and and is working close to downtown. So yeah, you can get comfortable the fact that most of the tenants will be driving to a lot of the amenities. If you are really close to shopping and restaurants, that is certainly a boost, but it's not a requirement.
Yeah. Okay, great. And then one on evictions. So, what would the eviction process look like should tenants fail to abide by the rules and guidelines?
Yeah, the vast majority of people that are behind on rent, what ends up happening is they get behind a couple weeks, a month. You send an escalating series of letters, right? And they fix it, right? They view, hey, okay, I'm gonna do something extra to catch up because I do not want to lose this home. The few that do go through the entire process, then it depends on the state, right? But in states like Texas, it happens pretty quickly. In states like New York, there are professional tenants that can drag things out. And so you just have to underwrite that risk. There are a couple operators that specialize in those kind of markets, and they just get laser focused on making sure they're not a day late on any of those markers in order to either get that lot back, or have the tenant take their home and move out of the park. And so it doesn't happen as much as you think, because people are so invested in the property, or they can just decide if something really nuclear happens in their life financially, but they're in the good market, they often can sell their home pretty quickly, right? Because people like the fact that the lot rent is so low, and they can, as we talked about, they can extend their retirements. They can have a functioning retirement with that low lot rent. And so the homes can go quickly in really good markets. And so therefore you don't have as high a percentage of eviction completion versus a lot of other asset classes.
Yeah. All right. There's one that I'm going to give an answer to. So, are you concerned at all with the executive order that Trump signed preventing companies from owning more than 100 homes? Do you have a lot of POHs in your portfolio? So, there's two parts to that answer. One, no, we're not concerned. Mobile homes are in a completely different legal category from site-built traditional homes that are real estate. These function as personal property or chattel, and so are completely outside of what's being targeted from that discussion. And then I guess the second part to the answer, on the whole, we do not have a lot of park-owned homes in our portfolio. They do pop up, but typically they're there to try to continue boosting occupancy and then longer term to be sold off to tenants in most cases.
Yeah, I'll just add to that on some of the higher return opportunities that can underwrite to 20 plus IRRs are higher risk, right? Higher business execution risk. And those would involve park-owned homes where you have a park that there's a lot of vacancy, and maybe it's in the Southeast, and maybe there's 25% vacancy. And instead of waiting for people to move their own home into your lot, you want over a 3 to 5 year period, you really want to push the capital investment, increase occupancy. You would buy homes, right? Or you can use debt to go out and finance the homes in order to really increase occupancy quickly. And then over time, you'd go through and sell off those homes, but you'd be doing it at a much larger income base than when it was 75% occupied. So that's part of the type of deals that we view as opportunistic, right? The value, the core plus value add spectrum. Most of the deals that we do tend to be mostly tenant-owned homes.
Yeah. All right. Well, I think we're kind of winding down here. One more that I do want to make sure that we cover. Would you also say that given the high multiples, these public REITs may be overpriced compared to multifamily REITs? I like the idea of the predictability argument, but curious to get your take.
They were 30x on AFFO a couple years ago prior to the rate correction. So 30 was clearly not the right number for the environment that we're in. But I don't know. That's the thing with the REITs. You're getting the benefit of the liquidity. You're not going to be able to hit 15 IRRs, right? It's just over long periods of time. That's not going to happen, right? The publicly traded REITs for both manufactured housing and apartments are going to be in that 9-11% range, depending on how great the future goes for them. They're not going to be mid double digits. That's you have to get compensated, or you have to get a discount for that liquidity. So yeah, I don't know. That's a good question. The reason why we include it is just I think it's a great data point, and it helps solidify the thesis that we've laid out here today, with a large amount of people looking back over a lot of data have decided that this business model is worth more on a per dollar basis than apartments. Not to say that apartments aren't great investments. Like, I've invested in apartments before. It's fantastic to be able to put a lot more money out. That is, one of the downturns about this space is you can't put $1 billion to work quickly in our space. There's not enough inventory. You have to be more of a sharpshooter. But anyways, I will end with that. I just wanted to thank everybody for joining the call today. I know we went into the weeds here on data. We've had other presentations where we've kept it more of a high level, talked more about the business models, the type of operating business plans. But this one, we really wanted to focus on the data comparative to apartment buildings, because we know a lot of people are looking to expand their real estate investment portfolio beyond apartments. And we think this is a great option for you to do that. And with that, I'll say goodbye. Anything else you want to say, Ian?
No, thanks so much. We love the space. I think that probably comes through. This is what we spend our day in and day out doing. By all means, always welcome individual outreach and one-on-one conversations, and we'll be in touch.
Thanks, everybody.